Hi, we have just had the union budget that was presented earlier today, which probably is the last budget of the present government before elections next year. While there will be a lot of nitty-gritties and observations in the fine print, let us focus on key things that matter most to the long-term investors. First, let us look at the important number on fiscal deficit, a difference between government receipt and expenditure. Fiscal deficit number for financial year 19 has been forecast at 3.3% of GDP as compared to consensus forecast of 3.2%. The broad assumption on revenue and expenditure appear credible, except for personal income taxes being slightly aggressive on collection assumption. Overall, government appears to be committed towards fiscal reforms. The divestment target in financial year 19 is Rs 80,000 crore. This again seems reasonable to achieve and appears conservative considering the financial year 18 divestment target is up to Rs 1 lakh crore. With most measures of taxation under GST, the budget had little to do with indirect tax changes. From a capital market perspective, the fear of long-term capital gains tax being introduced has actually happened. Long-term capital gains exceeding Rs 1 lakh will be taxed at 10% without benefit of indexation. However, the good part is that all gains till 31st Jan 2018 will be grandfathered. That is, any gain earned after 31st Jan 2018 will be charged at 10%. For example, if a stock is bought at 100 and has touched 120 on 31st Jan 2018 and the sale happens at 140, the tax will be on 20 and not on 40. This is an important and wise decision, which means that all legacy long-term gains up to 31st Jan 2018 is exempt and one needs to pay 10% tax on only incremental gains, and that too if the sale happens in financial year 2019. Short-term capital gain tax, however, will continue to be taxed at 15%. The finance minister expects these schemes will bring in Rs 20,000 crore in the first year. Market was expecting the worst in the form of long-term capital gains tax. Thankfully, it is grandfathered and it is not retrospective, but only a prospective impact. Gains made so far is safeguarded with zero tax. The budget provides huge gains for the MSME sector. The budget extends reduced corporate tax rate of 25% to small and mid-sized companies with turnover less than 250 crores. This covers almost 99% of companies that are paying taxes. Lower taxes mean lesser incentive to generate cash and be more transparent in accounting for revenues. In line with expectations, government focused disproportionately high on rural economy in the budget. Two key initiatives which we believe can have a positive impact are: number one, formalization to determine minimum support prices or MSP and looking for mechanism to ensure farmer receives MSP. And number two, health insurance to cover 10 crore families and about 50 crore beneficiaries. The initiative covers a significant 40% of Indian population and can therefore potentially move the needle in terms of poverty alleviation to an extent. Importantly, it provides a very scalable and sizable social security net to the rural poor and is an Indian version of Obamacare. These measures on rural and agriculture will eventually boost rural consumption. Let us also focus on some disappointments or negatives in this budget. There is no major change in individual tax exemption limit except for providing Rs 40,000 as standard deduction on medical or conveyance. This will only have a marginal increase in disposable income.